You entered the trade at $53. Your stop loss is at $52.20. The trade moves against you. Price hits $52.50. You're down $150. Then, something shifts in your thinking. The setup still looks valid. The price is now even more attractive than your original entry. This is actually an opportunity. If you were willing to buy at 53, buying at 52.50 is even better, right? You add to your position. You tell yourself you're averaging down, being strategic, taking advantage of the dip. You're not panicking. You're being opportunistic. Price continues dropping. 52.30, 52.10. Both positions are now underwater. Your loss has escalated from $150 to $430. Your original stop at $52.20 should have taken you out, but you moved past it by adding to the trade. Now, you're sitting on a loss 3 times larger than planned, and you're frozen, unable to exit. This pattern has destroyed your account multiple times. You know it's wrong. You've promised yourself you'll stop doing it. But when you're in a losing trade, the urge to add to it becomes overwhelming. Your rational brain screams not to do it. Your emotional brain finds 1,000 reasons why this time is different, why adding makes sense, why you can turn this loss into a win. Until you understand the psychological mechanism driving this behavior, you'll keep repeating it. And every time you repeat it, you're one trade closer to destroying your account completely.
The psychology of adding to losers. Here's what's actually happening in your brain when you add to a losing trade, and why it feels so logical in the moment, even though it's catastrophic to your trading. The core driver is something psychologists call loss aversion, combined with a cognitive bias called commitment escalation. Loss aversion means humans feel the pain of losses roughly 2.5 times more intensely than the pleasure of equivalent gains. This asymmetry makes losing trades psychologically unbearable. When you're in a losing trade, your brain isn't just processing a financial loss, it's experiencing genuine psychological pain. Brain imaging studies show that financial losses activate the same neural regions associated with physical pain. Your brain is literally hurting. Now, humans have a powerful drive to eliminate pain. When you're in physical pain, you'll do almost anything to make it stop. The same mechanism activates with psychological pain from trading losses. Your brain desperately searches for any action that might eliminate or reduce the pain. This is where commitment escalation enters your trading psychology. You've already committed resources, money, time, and ego to this trade. The idea of accepting that commitment as a complete loss is psychologically devastating. It means admitting you were wrong. It means accepting that your analysis failed. It means experiencing the full pain of the loss. But what if you could avoid admitting wrongness? What if you could transform this losing trade into a winning trade? Then you wouldn't have to experience the pain of loss. You wouldn't have to admit error. You could preserve your self-image as a competent trader. Adding to the losing trade creates this possibility. If you average down and price recovers even partially, you might break even or profit. The additional position transforms a guaranteed loss into a potential win. Your brain finds this option irresistibly attractive because it offers escape from pain. The problem is that this escape is an illusion. You're not reducing risk by adding to losers. You're multiplying risk. You're not being strategic. You're engaging in what psychologists call throwing good money after bad, one of the most destructive decision-making patterns humans exhibit.
The rationalization engine, how your brain justifies the unjustifiable. The most insidious aspect of adding to losing trades is how rational it feels in the moment. Your brain doesn't tell you, "I'm panicking and making an emotional decision." It provides you with seemingly logical justifications that feel like sound trading strategy. Here are the most common rationalizations that your emotional brain generates. Rationalization 1. The value investor fallacy. If I liked it at 53, I should love it at 52.50. The price is better now. This is how smart money accumulates positions. Warren Buffett averages down. This is value investing logic applied to trading. The flaw. Value investing and short-term trading are fundamentally different activities with different risk profiles and time horizons. Warren Buffett can hold positions for decades while fundamentals play out. You have a stop loss at 52.20 because your technical setup has an invalidation point. The setup failed. Adding to it isn't value investing, it's denial of the technical failure. Rationalization 2. The revenge against the market. The market is wrong here. This is obviously going higher based on my analysis. The market just doesn't see it yet. I'm going to add to my position and prove that my analysis was correct. When this recovers, I'll have made even more money. The flaw. The market is never wrong. The market is what it is. Your analysis might be correct about eventual direction, but your timing was wrong. And in trading, timing is everything. Adding to a losing trade because you're convinced you're right and the market is wrong is ego-driven revenge trading disguised as conviction. Rationalization 3. The break-even obsession. If I add here at a better price, I can get back to break even much faster when it recovers. I won't even need it to reach my original entry. Just a small recovery and I'm out without a loss. This is smart risk management. This isn't risk management, this is loss avoidance psychology. You are now carrying double the position size with double the exposure. If the trade continues against you, your loss will accelerate dramatically. You've transformed a controlled loss into an uncontrolled gamble. Rationalization 4. The selective memory justification. I remember that time I added to a loser and it came back and I made money. That proves the strategy can work. I'm not being reckless, I'm being strategic, like I was that time before. The flaw. Your brain is using selective memory, retrieving the 1 or 2 times adding to a loser worked while ignoring the dozen times it made losses catastrophic. This is confirmation bias in action. The occasional success doesn't validate the strategy, it makes it more dangerous by providing intermittent reinforcement that keeps you repeating the behavior.
Meet Yale, the trader who couldn't stop averaging down. Yale had been trading for 5 years when he finally confronted his adding to losers problem. He wasn't a novice. He understood position sizing, risk management, and the mathematical destructiveness of averaging down. He had read every trading psychology book that warned against this behavior. But Yale kept doing it anyway. His trading journal documented the pattern with painful clarity. Over the past 18 months, Yale had added to losing positions 43 times. Out of those 43 instances, 38 resulted in larger losses than his original stop would have produced. Only 5 times did the trade recover enough for him to exit at break-even or small profit. Those 38 failed averaging down attempts had cost Yale an additional $18,300 beyond his planned stop losses. If he had simply honored his stops, his account would be $18,300 larger. But the financial damage wasn't even the worst part. The psychological damage was more devastating. Every time Yale added to a loser and it failed, he proved to himself that he couldn't trust his own trading decisions. His confidence eroded. His analysis became suspect in his own mind. His entire approach to trading felt unreliable. Yale had tried multiple times to stop this behavior. He made rules, he wrote commitments, he even put reminders on sticky notes around his monitors. Do not average down, ever. None of it worked.
When he was in a losing trade, watching his money disappear, feeling the psychological pain intensify, all his preparation evaporated. His emotional brain would generate compelling rationalizations. His hand would move to the mouse. He would add to the position, and then he would watch in horror as the loss multiplied. Inside Yale's mind, the averaging down decision. Yale decided to document his internal dialogue during a typical averaging down episode to understand the exact psychological process. The initial entry. Monday morning, Yale identified a breakout setup on a stock trading at $42.30. His analysis was solid. Multiple time frames aligned. Volume was confirming. His stop loss was $41.80, risking $150 at 2% of his account. Yale's internal dialogue. This is a textbook setup. Everything aligns. Entry at $42.30, stop at $41.80, target at $44.50. 3-to-1 reward risk. This meets all my criteria. Taking the trade. He entered the position with confidence and discipline. The initial movement against him. Within 20 minutes, price started dropping. $42.10, $42 even, $41.90. Yale's position was now down $120. Yale's rational brain. This is moving against me. That's normal. Not every trade works immediately. My stop is at $41.80. If it hits, I take my planned loss and move on. Yale's emotional brain. This doesn't feel good. You're losing money. This is painful. But wait, look at the chart. The structure still looks valid. This might just be a shakeout before the real move. The critical decision point. Price hit $41.90 and stabilized. Yale was down $130, $10 away from his stop loss at $41.80. This is when Yale's internal dialogue shifted dramatically. Emotional brain. Okay, think about this logically. You entered at $42.30 because you thought this was going higher. Now it's at $41.90. That's even better value. If your analysis was right at $42.30, it's definitely right at $41.90. Rational brain. Your stop is at $41.80. That's where your setup is invalidated. Don't add to this position. Emotional brain. But look at the chart. It's holding above the key support level. It's not breaking down. This is probably the bottom. If you add here, you can average down to $42.10. Then you only needed to get to $42.10 to break even, not all the way to $42.30. You're reducing the price you need for recovery. Rational brain. You're doubling your risk. If this goes to $41.80, you'll lose $300 instead of $150. Emotional brain. It's not going to $41.80. Look at the support. It's holding. You're being presented with an opportunity here. Smart traders accumulate on dips. This is a dip. Add to the position. Lower your average price. This is strategic. Rational brain. This is exactly what you always do before you blow up a trade. Don't do this. Emotional brain. That was different. Those times you didn't have confirmation. This time you can see the support holding. This time is different. Add now before you miss this opportunity to lower your cost basis. Yale's hand moved to his mouse. He clicked. He added to his losing position at $41.90. The acceleration. Price continued dropping. $41.70, $41.50, $41.30. Both positions were now significantly underwater. Yale's loss had escalated from $130 to $340. Yale's internal dialogue now was pure panic mixed with desperate hope. This can't be happening. It was supposed to hold. The support looks solid. Maybe I should add again. If I add at $41.30, my average goes even lower. I only needed to get to... No. Wait, that's 3 positions. That's too much risk. But I'm already down $340. What's the difference at this point? If I don't add, I'm definitely losing $340. If I do add, I might be able to get out at break even when it bounces. Yale added a third time at $41.30. His average entry was now $41.80, exactly where his original stop loss was. His total exposure was triple his planned risk. His loss, if he exited immediately, would be $480, more than triple his original risk. The catastrophic conclusion. Price dropped to $41. Yale finally exited all 3 positions. His total loss, $570. His planned loss on the original trade, $150. By adding to the losing position, Yale had turned a controlled, manageable loss into a catastrophic one that wiped out 2 weeks of profitable trading. Sitting there after closing the positions, Yale felt physically sick. Not just because of the money, because he had done it again. He had violated his rules again. He had added to a loser again. And he knew, with crushing certainty, that this pattern would probably repeat on future trades unless something fundamentally changed in his trading psychology.
The anatomy of adding to losers' destruction. Yale analyzed his pattern and identified exactly how adding to losing trades destroyed his trading performance. Destruction Pattern 1. Exponential risk multiplication. When Yale added to losing positions, his risk didn't just increase arithmetically, it multiplied exponentially. The first position risked $150. Adding doubled that to $300. Adding again tripled it to $450. But the psychological impact was even worse than the mathematical impact. Yale's entire risk management system collapsed. His careful position sizing became meaningless. His 2% risk rule disappeared. He was now risking variable amounts based on his emotional state in the moment, not his systematic risk calculations. Destruction Pattern 2. Stop-loss invalidation. The moment Yale added to a losing trade, his original stop-loss became irrelevant. He had moved past his invalidation point. The setup had failed, according to his original analysis, but by adding, he was creating a new, undefined setup with no clear risk parameters. This left Yale in a psychological no-man's land. He didn't have a clear exit plan anymore. He was just hoping for recovery. Hope is not a trading strategy, and hoping your way out of losing trades is a guaranteed path to destruction. Destruction Pattern 3. Emotional spiral amplification. Each time Yale added to a losing trade, the emotional intensity amplified. The first position created normal loss anxiety. The second position created elevated fear. The third position created panic. This emotional amplification impaired his decision-making progressively. By the third edition, Yale wasn't thinking rationally at all. He was in full emotional reactivity mode, making decisions purely to escape psychological pain rather than based on any coherent strategy. Destruction Pattern 4. Recovery paralysis. After adding to losers multiple times, Yale would become paralyzed. His losses were so large that he couldn't accept them, but the position kept moving against him. He would sit frozen, unable to exit, unable to add more, just watching the loss grow. This paralysis often resulted in even larger losses as he waited for a recovery that never came. The psychological burden of the oversized loss prevented him from cutting it when cutting was still possible. Destruction Pattern 5. Pattern reinforcement through intermittent success. The cruelest aspect of adding to losers was the occasional success. 5 times out of 43, Yale's averaging down worked. The trade recovered. He got out at break-even or small profit. These rare successes created powerful, intermittent reinforcement in his trading psychology. His brain learned, sometimes adding to losers saves the trade. This made the behavior incredibly difficult to extinguish, like a gambling addiction where occasional wins keep you playing despite overall losses. Yale's transformation building addition-proof systems. Everything changed when Yale stopped trying to control his behavior through willpower and built systems that made adding to losers impossible. System 1. One position rule.
Yale implemented an absolute rule: one position per setup, period. No exceptions. If he entered a trade, that was his only entry on that particular setup. He could not add, average down, or scale in under any circumstances. To enforce this, Yale created a physical trading checklist. Before every trade, question 1 was, do I already have a position on this setup or instrument? If yes, he was not allowed to add to it regardless of his analysis or conviction. This simple rule eliminated 90% of his adding to losers behavior immediately. He couldn't add even if he wanted to because the rule was absolute and the checklist enforced it. System 2. Stop-loss automation. Yale configured his trading platform to automatically close any position that hit his predetermined stop-loss. He couldn't watch trades approach his stop and decide whether to honor it. The platform made the decision automatically. This removed the critical decision point where he used to add to losers. By the time Yale was aware his stop had been hit, the position was already closed. There was no opportunity to add, no moment of temptation to average down. System 3. Post-loss lockout period. Yale implemented a mandatory 30-minute lockout after any stopped-out trade. His platform was configured to prevent him from entering new positions during this period. This lockout prevented revenge trading, but it also prevented him from immediately re-entering the same setup at a lower price, which was a form of averaging down. The 30-minute cooling period allowed his emotional reactivity to subside before he could make new trading decisions. System 4. Maximum loss per trade ceiling. Yale programmed a hard maximum loss limit per trade into his risk management system. Regardless of how many times he might theoretically add to a position, his total loss on any single setup could never exceed $300. If he somehow violated his other rules and added to a losing trade, the platform would automatically close all related positions once the total loss reached $300. This created a safety net that prevented catastrophic losses even if his other systems failed. System 5. The Addition Intention Journal. Every time Yale felt the urge to add to a losing trade, he was required to write a detailed journal entry before being allowed to act. The entry had to answer, why do I want to add to this position? What has changed about the setup that justifies adding? What is my new stop loss if I add? What is my total risk if I add and the trade continues against me? Am I adding based on new analysis or based on not wanting to accept the current loss? Writing these answers took several minutes. By the time Yale finished, either his stop had been hit automatically or the emotional urgency to add had passed. The journaling requirement created enough friction to interrupt the impulsive adding behavior.
The breakthrough realization. 8 months into his transformation, Yale was in a trade that moved against him. He felt the familiar urge to add to the position, to average down, to fix the losing trade. But this time, something different happened. Yale observed the urge without acting on it. He noticed his emotional brain generating rationalizations. He could feel the psychological pain of the impending loss, but he also recognized something profound. This urge to add has nothing to do with trading strategy. It's pure loss avoidance. I'm not trying to improve my position. I'm trying to avoid admitting I was wrong about this trade. The market has told me clearly that my analysis was incorrect. Adding to this position won't change that. It will just make my eventual acceptance of being wrong more expensive. Yale's stop was hit. He lost exactly what he had planned to risk. And for the first time in years, he felt completely at peace with it. Not because losing felt good, but because he had executed his plan with integrity. He had honored his stop. He had not added to the loser. He had accepted being wrong without trying to escape through position averaging. This acceptance, this ability to take a loss according to plan without trying to fix it, was the psychological shift that Yale had been searching for. He finally understood that accepting losses was not weakness. It was the foundation of successful trading.
Yale's results, the transformation in numbers. The changes in Yale's trading results after implementing his anti-averaging down systems were dramatic and immediate. Before systems, Yale violated his stops by adding to losing positions on 38% of his losing trades. These violations cost him an average of 64% more than his plan to stop losses. His largest single loss was over 7 times his planned risk due to multiple additions. Annual return? -4%. After systems, Yale added to losing positions on 0% of his trades. His technical systems made it impossible. His average loss matched his planned stop loss almost exactly. His largest single loss never exceeded his predetermined maximum. Annual return over the next 16 months, 26%. Same markets, same basic strategy. The only difference was that Yale stopped adding to losing trades. More importantly, Yale's psychological experience transformed. He stopped dreading losses. He stopped experiencing the emotional spiral of watching small losses become catastrophic ones. Trading became psychologically sustainable.
How to break your adding to losers habit, your action plan. If you recognize this pattern in your own trading, here's your systematic approach to breaking the habit. Step 1. Quantify the damage. Review your last 6 months of trades. Identify every instance where you added to a losing position. Calculate the additional loss you incurred versus what your original stop would have cost. Make this damage concrete and visible. You need to see the real cost, not just understand it abstractly. Step 2. Identify your trigger moments. At what point in a losing trade do you typically feel the urge to add? When you're down 50% of your planned loss? 75%? Right before your stop is about to be hit? Document your specific trigger pattern. You cannot intervene in a pattern you haven't identified. Step 3. Implement the one position rule. Create an absolute rule. One position per setup, no exceptions. No averaging down, no scaling in after entry. One position, one entry, one exit at target or stop. Make this rule inviolable. Create a physical checklist that enforces this rule before every trade entry decision. Step 4. Automate your stops. Configure your trading platform to automatically execute your stop losses. Remove your ability to watch trades approach stops and make emotional decisions about whether to honor them. Automation removes temptation. Step 5. Create post-loss lockout. Implement a mandatory cooling-off period after any stopped-out trade, 30 minutes minimum. During this period, you cannot enter new trades. This prevents immediate re-entry at lower prices, which is essentially averaging down across separate trades. Step 6. Build addition friction. If you feel the urge to add to a losing position, require yourself to write detailed answers to specific questions about why you're adding and what your new risk is. Make this written requirement mandatory before any addition is allowed. The friction this creates will interrupt most impulsive adding behavior. Step 7. Set hard maximum loss limits. Program your trading platform or risk management system with absolute maximum loss limits per trade. Regardless of how many positions you might try to add, the total loss cannot exceed this limit. This creates a safety net for worst-case scenarios. Step 8. Practice loss acceptance. After every stopped-out trade, spend 3 minutes consciously practicing acceptance. Remind yourself that this loss is normal, expected, and part of your trading edge. Reduced psychological pain from losses will reduce the desperate urge to escape losses through position averaging.
The fundamental truth about adding to losers. Here's what Yale ultimately learned. Adding to losing trades is never about improving your trading position. It's always about avoiding psychological pain. When you add to a losing trade, you're not making a strategic trading decision. You're making a psychological decision to delay accepting that you were wrong. You're prioritizing short-term emotional relief over long-term trading success. The market doesn't care about your average entry price. It doesn't care that you added at a better level. It only cares about its direction. And if that direction is against you, every additional position you add is just more capital exposed to the wrong direction. Successful traders don't add to losing trades. They honor their stops. They accept being wrong quickly. They cut losses systematically. They understand that preserving capital through proper risk management is more important than being right on any individual trade. Your urge to add to losing trades is not a character flaw. It's a natural human response to loss aversion that happens to be catastrophic in trading contexts. You can't eliminate the urge, but you can build systems that prevent you from acting on it. Stop trying to fix losing trades. Start accepting them. Stop adding to positions moving against you. Start honoring your stops unconditionally. That's how you break the adding to losers habit. That's how you protect your capital. That's how successful trading becomes possible. Your stops exist for a reason. Honor them. Your losses are part of your edge. Accept them. Your temptation to add to losers is your ego trying to avoid pain. Recognize it and refuse to act on it. Build systems that make adding to losers impossible. That's the only solution that actually works.